The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Ben Boulos. These are your headlines. SK Hynix becomes the latest member of the $1 trillion club, echoing moves in Micron overnight as investors pile into artificial intelligence-linked semiconductor stocks.
Well, Iran says the US has committed a flagrant ceasefire violation as President Trump prepares to hold a cabinet meeting amid high-stakes negotiations to try and strike a peace deal. New car registrations in the EU jumped 5.1% in April as high fuel costs drive a surge in electric cars. But it's not all good news for EVs, as Ferrari's first foray into the field, a lot of F's there, is ridiculed, sending the stock sharply lower.
BP removes Albert Manifold as chair less than a year into the job amid concerns over his behaviour, oversight and governance standards.
It used to be a fairly exclusive club, but no more. South Korean chipmaker SK Hynix is the latest member of the $1 trillion market cap club. Shares surging this morning as investors pile into the artificial intelligence-linked semiconductor stocks. The rally extends a blistering run that has seen SK Hynix shares skyrocket more than 1,000% over the last 12 months. The moves echo trade on Wall Street overnight, with chipmaker Micron also topped $1 trillion in market value for the first time, fueled by surging demand for high bandwidth memory chips used in AI servers and accelerators. And of course, one of the big contributors when it comes to the S&P 500 and the Nasdaq performance overnight. Look at what you're seeing on the Asian markets and across the board, the early picture. Japanese stocks are up about 0.5%. The Kospi, though, again, that has ticked higher, 8,200 plus, 8,261 on the chart, so it's 2.6% bounce. You've got 1% on the Hong Kong market and Shanghai up 1.1%. But there's the point. We used to be talking about billion-dollar companies. Now we're talking about trillion-dollar companies that have been inked. All of this thanks to the incredible advances we've seen in AI. There's just a couple of other stocks really that are not right at the forefront of that story, but mostly they are AI stocks. And I think investors still piling into names where they see that there's a crunch. They can see Micron has had a memory chip crunch, SK Hynix. Investors know that this is going to be the picks and shovels of the era, and they're still pushing these names higher.
Sorry, Ben.
No,
you
go
go
ahead.
ahead. No, I won't say a word.
No, I was going to say, it's all very well. I'll play that again. Chicken. It's all very well when things are on the rise and you have that concentration, you know, the names like SK Hynix and Samsung lifting the Korean index. But if they wobble, you know, as we saw when there was the labour dispute at Samsung, it can drag the whole index down. You know, I think it's quite prudent to remember there's the downside risk of the concentration in one or two big names, as well as the benefits when it's on the upside.
I think you've covered it, guys. I mean, the fact of the matter is, every single one of these companies is the same trade. It's different parts of the same trade, but looking top down, it's the same trade. It's not. You think this company is a value company, you think this company's got great dividends, you think this company's got great cash flow. It's basically the AI trade, and it's people looking at different parts of the AI trade. Now, it may be the right trade to have. It may be that growth continues, and that is where we go. But you have got enormous concentration when you buy. I don't know how many $1 trillion. Did you say how many $1 trillion companies there are? I don't even know. Was it 6 of them, 7 of them?
No, about 12 these days.
Okay, well, so it appears to be the same trade. So that's great. Knock yourselves out. It's good, but it's not giving you much diversity in your portfolio.
Well, exactly, and that's the problem. I think the other situation is you've now got capacity constraints. That's what investors are buying into. You've got sort of pretty much sold out for SK Hynix as you look out through 2026 in terms of what they can provide to the market. So you're starting to look out not just around income for this year, but for future years. What sort of income can they provide for 2027? What prices they're going to be selling into? And I think that's what the market starts repricing around, because they're not sure what that's going to look like by then.
You've got, having said it's the same trade, my bites, there are different parts to this. I mean, you've got the picks and shovels that appear fairly unique at the moment, which is Motive, which is your Nvidias of this world. You've got your picks and shovels, which is just bog standard. We are short of the bog standard chips, the CPUs, whatever. We need to get those to market. Then you've got the hyperscalers who have many tools going on, and if it really is a big flop at the end of the day, then they've got other stuff they're going to be great at anyway, like Google, like Amazon, what have you. And then you've got the outright punts on the profitability of AI going forward with the likes of OpenAI and Anthropic, where you just don't know what the demand is going to physically look like in 5 years. Having said it's the same trade, you can buy yourself diversity within that trade.
Yeah, just a couple points here. I mean, you've got customers that are effectively now securing supply in high band memory width right out from 2027 to 2028. So that's just how far out the supply chain is getting locked up. But keep in mind, there have been warnings out there around financial stability, and they relate to semiconductors, that if you do get a market event, that this is an area that is by no means immune. And, I've been around long enough that I covered the last time we had a crash in semiconductors. It happened on the back of the last financial crisis. We were talking about this crunch, what it would take to solve it back around 2010. So there can be links here. And don't forget, one of the biggest issues that people have is that you've got this circular system that is happening in AI, and a lot of that is around leverage. So if there's a problem in credit markets that starts to catch up with AI, then memory chips are not going to be immune to that situation either.
Yeah, and it's interesting when you look at the runaway exuberance here. It's the journal's done some data crunching on this, and Micron is the fastest company to have reached the $1 trillion mark. It's the 12th US company to reach the $1 trillion valuation, doing that in just 48 days from half trillion to $1 trillion, eclipsing even the likes of Walmart, Nvidia, Microsoft, Eli Lilly, Amazon, like all of the other big names that achieve that elusive membership of the $1 trillion club. And I just wonder whether, when you see that sort of runaway exuberance, maybe it's a time to just have a little note of caution.
And well, the optics certainly changed. I mean, the last big story we were covering on Micron was its inability to really sell into the Chinese market because of some of the security constraints. So things have really changed around the AI story for it. But it was the big driver for the likes of the S&P 500 and the NASDAQ, the top performing stock for both of those indices that again notched up fresh records intraday and by the finish. If you look at the NASDAQ, the performance that you've seen for that market since the Iran war began, up 17.5%. So big double-digit swings for the NASDAQ despite conflict taking place, and this is where we ended up. The Dow, though, in reverse, gave back some territory. United Health was the underperformer there. In terms of the European futures, we saw the market breaking a six-day winning streak on the benchmark, the Stoxx Europe 600. Perched higher was the FTSE 100 as it played catch-up after bank holiday, but other major boards gave back territory. We're down 1% plus on the French market, for instance. So this morning, as we gear up for trade, we're looking for a bounce back in quarters of the market, where the DAX is looking to secure about 0.33%. US futures, the early starting point seems to be that we could see again those records extended for the S&P and also for the NASDAQ. Slim ranges, but still pointing higher. The NASDAQ also called higher this morning. And let's get to Felipe Ferreira, who is the Deputy Head of Economics and Cross-Asset Strategy at Kepler Cheuvreux. Felipe, thank you very much for joining us today. Just explain what you're looking at, because we just fleshed out some of the exuberance we're seeing around the artificial intelligence story. But I know that top economists are also worried about the economic risk that may come from this super trade that is unfolding.
Well, economic risks at the moment are more related to high oil prices and the fact that consumers are being squeezed. And the AI trade is a concentration risk, but we've seen that before. 10 years ago, if you remember, we were all worried about concentration in the NASDAQ and the tech team. So this is somewhat a deja vu. But, well, the economic risks are on the consumer side, but we've seen the capex around AI taking the lead, especially in the US economic growth. So capex infrastructure. We also see themes kind of electrification, energy transition after this new energy shock taking the lead and supporting as well the economy and market. So there are risks, but we also see a lot of opportunities.
The market is stampeding, though, in one direction. We've also seen this playbook before where other asset classes get left behind. Do you think we could see more diversification from the trade at some point?
Well, we expect at some point bonds to perform better, especially if oil prices and inflation expectations are lower. But for the time being, bonds are the great losers, I would say. because you've done nothing year to date. So if you want to kind of have a less risky portfolio with bonds, you are a bit squeezed, and this is not really performing. So that's the next asset class, perhaps to see some more positive developments if oil prices go down on the back of a US-Iran deal.
Philippe, I notice that from your observations that you had sold some equities to increase your cash holdings, but you have now redeployed that cash according to the moves that we've seen in the news flow. Just explain where you've positioned and why.
Well, we think we have to be overweight equities overall in a global portfolio because we are experiencing a very strong cycle. And we see a lot of resilience. If you remember last year, we had the trade tariffs, and despite all the noise and all the volatility, equities managed, and corporate profits are very strong. You know, even in Europe, corporate profits are significantly better than expected by analyst consensus. So we think we have to capture that trend. It would be a mistake to sell it too early. And well, corporate profits are backing the market rally. This is really something that is happening, plus 30% EPS growth for the S&P, plus 10% EPS growth for the Stocks Europe 600. And within the indices, there are sectors where earnings are growing at 50%. So this is something concrete behind.
I noticed also you referred to increasing your exposure to gold, but perhaps counterintuitively, if geopolitically there's optimism that the situation could resolve. Just explain that, and also your perspective on UK gilts as well, because that's featured in your observations.
Yes. So first, gold was impacted negatively by the conflict, which is a bit counterintuitive because you would expect gold to perform well when geopolitical risk is high. But in fact, gold was impacted negatively by the rise in oil prices and the rise in rate expectations from central banks. So gold was left behind in the past few weeks and months. And if oil prices go down, inflation expectations go down, gold might recover towards $5,000 per ounce. This is our view. And regarding gilts, well, this is a high carry segment in government bonds, delivering significant coupon. And well, gilts were impacted negatively by the political turmoil in the UK, which looks like behind us. And well, we look for a recovery in gilts and try to take advantage of this attractive carry in UK government bonds.
Which is interesting, Felipe, because when you went on your cautious stance, you went to cash rather than to bonds. Why?
Yes. Well, because if you want to hedge against conflict escalation, and a few days ago, Trump was talking about initiating military bombings again. If you fear that risk, then bonds are not an appropriate hedge, because if the conflict escalates again, oil prices could go to $140, $150 per barrel. And in that case, you don't make money with bonds. Bonds are not helping your portfolio to protect it in that scenario. So cash is a few alternatives if you want to hedge against conflict escalation.
Okay, let's play scenarios here. Let's say the war does end. There's positive mood music at the moment, but we're ongoing. The war ends and traffic goes through the Strait of Hormuz and there's no more bombing. What happens to that cash position then?
Well, this cash position would be underperforming in that case. That's why we've been redeploying it as we see signs of conflict resolution again in the past few days.
What do you do with it? Do you put it into bond markets because of the attractive yields and the fact that it'll be less inflationary pressure, or do you go back into the equity market with it?
Well, back into the equity market, some parts, and we try to, play the momentum. The trend is your friend in that case. But also we try to take advantage of the attractive yields in bonds under the scenario of conflict resolution and lower inflation expectations, where we see some attractive carry there. But obviously your expected return in bonds is not the same than equities, but it's less volatile. That's the positive of bonds in that case.
Felipe, lovely to speak to you. Thank you very much indeed for joining us today, sir, out of Paris. Felipe Ferreira, who is the Deputy Head of Economics and Cross-Asset Strategy at Kepler Chevreux. China's industrial profits posted their fastest gain in over 2 years in April, surging 24.7% on the year. This despite broader signs of slowing economic momentum in the world's second largest economy. Elaine joins us with more. Elaine.
Hey, Steve. So the number you just mentioned, that's the fastest growth since November 2023, and it's accelerating sharply from the 15.8% jump in March. And that brings gains in the first 4 months to 18.2%. Now, economists say that this growth is sector-driven and uneven, though, with the AI and chip boom fueling demand for AI-related electronics. And the Middle East conflict and energy crisis as well. There are dueling forces there. So on the one hand, you have that pushing up raw material costs that is threatening to compress margins. But these higher commodity costs is also propping up factory gate prices. So that is actually bolstering the margins of upstream sectors. So if you look at profits in the raw materials manufacturing sector above a certain size, that jumped 88% in the first 4 months. And also you have rapid developments in AI, information technology, and also new energy driving up demand for non-ferrous metals like gold, lithium, and copper and aluminum. And that is driving profit growth in this sector by 11 and 17.8% in the first 4 months, which is faster than the first quarter as well. But there's a clear profit divergence, especially with downstream sectors. And this really highlights the long-standing mismatch between strong demand and weakness in China, and also the ongoing price war. So if you look at the auto manufacturing sector, profits there fell 16.8% in the first 4 months. And just a case in point, you have a Chinese EV giant BYD as well, recently posting a 55% drop in net profit in the first quarter. So that really shows, even with rising exports and growth overseas, it's not really enough to offset weak domestic demand. So these numbers, we have China's industrial engine. I also want to bring up coal here because, of course, you have the tragic coal mine disaster last week with a gas explosion that killed at least 82 people. So now we also see mines across the country suspending or reducing production now. So no doubt there will be more scrutiny on coal production, which is what has been giving China its energy buffer against oil price volatility alongside its renewable rollouts, of course. So with that coal incident, it also highlights the staggering human cost in China's coal production. Steve, it's back to you.
I'll pick up here, actually, Elaine. Thank you very much. Elaine, you there for us. Still to come on the show, Iran says the US committed a flagrant ceasefire violation as President Trump prepares to hold a cabinet meeting amid high-stakes negotiations for a peace deal. We'll have the very latest. Plus, BP's boardroom instability continues as Chair Albert Manifold is given the boot. We'll tell you why. And we'll bring you more from Lisa's interview with François Villeroy de Galhau. The French central bank governor says he's paying close attention to the bond market.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Hello, welcome back. Iran has condemned US strikes in the south of the country earlier this week as a flagrant ceasefire violation, warning aggression will not be left unanswered. The US characterized the strikes as defensive, saying they targeted missile launch sites and boats trying to lay mines. This as negotiations continue in an effort to secure a peace deal between Washington and Tehran and, crucially, reopen the Strait of Hormuz. The US President Donald Trump is due to hold a cabinet meeting today amid ongoing negotiations to strike a deal with Iran. The meeting was going to be held at Camp David, but has been moved to the White House, with the president pointing to the weather.
The US pressure campaign against Cuba appears to have entered a new phase, raising questions about what the endgame for the Trump administration looks like. Last week, the Department of Justice unsealed an indictment against the former Cuban president Raul Castro, accusing him of murder after the country shot down 2 planes in 1996 when he was defense minister. It comes amid a broader effort by President Donald Trump to push for regime change in the Caribbean nation, which has seen a recent tightening of economic sanctions, as well as a push to implement an oil blockade since January. Our very own Sam Meredith's been looking into this. Why, and why now?
Well, we probably have to go back to the start of the year to look at what the hallmarks of what looks like a pre-conflict playbook from the US. But Cuba is firmly in the geopolitical spotlight, principally because President Donald Trump has repeatedly said this country could be next in line once American troops withdraw from Iran. And that leaves this communist-run country facing its biggest test since the fall of the Soviet Union. So we really have to start with this audacious intervention in Venezuela, this operation to remove President Nicolás Maduro, and the subsequent imposition of a fuel blockade. We now know that Cuba has run out of oil, of course.
Sorry, I understand why Cuba was a threat in 1962, and when the world held its breath, and Kennedy faced down the Soviets, and they were building a potential nuclear capacity that close to the States. That's when Cuba was a big threat to the United States. Spin forward 60 plus years. Is Cuba really a threat to the US?
Well, maybe it's better to look at it through the lens of this so-called Donroe Doctrine, I guess, if you look at what...
As opposed to the Monroe Doctrine.
Well, of course, yeah, but I think the White House now is seeing itself as the sole arbiter of the Western Hemisphere. We've seen examples stretching from Greenland to Panama Canal, and now actually even Chile, with some subsea cables related to China. But now, of course, with Cuba, and what we're left with is this dangerous kind of will they, won't they scenario of whether the US will intervene militarily. Just in the recent weeks, actually, we've seen reports of some intelligence gathering flights over the coast of Cuba, which echoes a similar pattern that we've seen in the run-up to both Iran and Venezuela. So it does look like it is in the cards.
How invested do you think the Secretary of State, Marco Rubio, is in the fortunes of Cuba as well? I mean, he is a hawk on Cuba. He is the son of Cuban immigrants. Do you think he's a driving force for policy around Cuba?
I think very much so. Listening to him speak recently, though, on Cuban Independence Day, which was a symbolically important day when this unsealing of this indictment against Castro was revealed, he talked about how there was not a high chance for a negotiated settlement.
So he is angling for regime change?
It would seem so, yeah.
Venezuela, oil. Iran, who knows what it's about, but let's say it's about regime change and getting rid of the nuclear threat to the Western world as well. So let's go with the line coming from the administration at the moment. What is, apart from having more dominance, what is the point of tackling Cuba? What's the win?
It's hard to say. Listening to Trump, he talks about having the so-called honor of taking Cuba. It's hard to discern what he means by that necessarily. But, I mean, this massive economic pressure that Cuba is facing, the humanitarian situation is very extreme on the island.
Caused by the oil embargo.
Yeah, that's right. I mean, the UN...
And mismanagement of the economy. Let's add that in there as well.
Sure, of course. I mean, the UN has described the situation as dire even before the country had run out of oil. And we've seen reports recently of families using charcoal and wood to cook within their own homes, and also food rations running low too.
There was something else that happened around the time in the early 60s. And we park Kennedy's win, I think, over the Cuban nuclear crisis. There was the Bay of Pigs disaster. And a lot of our viewers will historically know about this one as well. When basically a US-inspired coup attempt failed dismally as well. It's not a slam dunk that if there is military action against Cuba, this is going to go well. And so, dare I say it, presumably their contingency planning is better than 60 odd years ago.
Yeah, well, a lot of the analysts I've spoken to have spoken to the fact that it would be a dangerous operation, and the Pentagon is well aware of this. So that's why they're in this kind of combustible will they, won't they scenario that persists to this day.
Okay, well, are you coming back and join us later?
Yeah, I think a couple of
Ben
times,
might get
yeah.
a word in edge.
I might.
Yeah, okay.
I was reading the article actually that you've written online, and there's so much in there that I'd love to explore in more detail with you. So hopefully we'll chat later.
Well, maybe you will get a word in. Sorry,
I'll try.
sorry. I was just fascinated by that whole period. I covered it quite a bit. Well, not personally, but read it. And for more on the story, I'm not that old. Maybe not. You can read, as Ben has done, read Sam's piece online on CNBC.com.
What was the quote? I'm not old. Was that what you said?
Sorry?
Was that the quote? I'm not old. Is that what you said?
No, I said I'm not that old.
Not that
I'm
old.
very old,
Oh,
but not
okay.
that old.
Not that
No, I
old,
wasn't around
okay.
in 1961 and 62.
Let's take a look at what we're seeing in futures to the European markets as we count down to the session, about 30 odd minutes to go. The FTSE picture looks a little bit soft this morning on the back of a bounce yesterday, 6 positive session in a row. But the European markets looking to reverse course after falling yesterday, looking to pick up a little bit of steam today.